Quote of the day. There are two main drivers of asset class returns, inflation and growth. Ray Dalio. Hello and welcome to today's video on the role of inflation in investing and how to protect your portfolio. Inflation is a phenomenon that affects all of us, and understanding its impact on investments is crucial for building wealth. Throughout this presentation, we will explore various strategies and investment options to safeguard your portfolio against the effects of inflation. Let's start by understanding what inflation is and how it impacts our investments. Unmasking the silent eroder, what is inflation? To understand the impact of inflation, we must first demystify its nature. At its core, inflation refers to the sustained increase in the general price level of goods and services over time. Imagine the prices of your favorite morning coffee or a loaf of bread rising year after year. It's this price creep that can slowly chip away at the value of your hard-earned money. Let's put it into perspective. Suppose you have $100 today. In a year with 3% inflation, those same goods and services that cost $100 would cost around $103. It may not sound drastic, but compound this effect over several years, and you'll witness the silent erosion of your financial strength. When inflation occurs, the purchasing power of money decreases, as it takes more money to buy the same goods or services. This has a direct impact on investments because the real value of future cash flows diminishes. To track inflation, various indicators are used, such as the Consumer Price Index, CPI, which measures changes in the prices of a basket of goods and services commonly purchased by consumers. Understanding inflation and its economic impact is essential for developing strategies to protect your portfolio. Let's delve into historical trends to understand how inflation has affected various asset classes. By examining past inflation rates and asset performance, we can gain insights into potential strategies for protecting our portfolios. Stocks and bonds have shown different levels of resilience during periods of high inflation, and understanding these patterns can inform our investment decisions. We will also explore the performance of real estate and commodities as potential hedges against inflation. By analyzing historical trends, we can make more informed choices to safeguard our investments in the face of inflationary pressures. Upon analyzing the chart, it becomes evident that equities assets exhibit a superior performance during periods of low inflation, whereas they tend to underperform during times of high CPI. Conversely, commodities exhibit an inverse pattern of performance. Asset allocation plays a critical role in protecting your portfolio from the impact of inflation. By diversifying your investments across different asset classes, you can reduce the risk associated with inflationary pressures. An effective asset allocation strategy involves spreading investments among stocks, bonds, real estate, and other asset classes. Diversification helps ensure that your portfolio is not overly exposed to any single asset class, thereby mitigating inflation risk. Additionally, effective risk management techniques, such as setting investment goals and regularly reviewing your portfolio, are essential for maintaining a well-balanced and protected portfolio. Let's explore these concepts with some of the financial products further. Inflation-protected securities offer investors a way to safeguard their portfolios against the erosive effects of inflation. Treasury inflation-protected securities, TIPS, are bonds issued by the U.S. government that provide protection against inflation. These securities offer investors a guaranteed real return that adjusts with changes in the Consumer Price Index, CPI. Investing in TIPS can help preserve the purchasing power of your assets during inflationary periods. Additionally, I-bonds, also issued by the U.S. Treasury, provide investors with another avenue for inflation protection. These bonds earn interest based on a fixed rate and a variable rate that changes with inflation. TIPS have a longer maturity period than I-bonds. TIPS typically have maturities of 10, 20, or 30 years, while I bonds have maturities of 30 years. Let's explore the benefits of investing in these inflation-protected securities. Here are some of the advantages of investing in TIPS and I bonds. Inflation protection. Both TIPS and I bonds offer inflation protection, which means that your investment will not lose value in real terms. Tax-deferred growth. The interest earned on TIPS and I bonds is tax-deferred until the bonds mature or are redeemed. This can help you grow your investment faster. Government backing. TIPS and I bonds are backed by the full faith and credit of the United States government, which means that you are guaranteed to get your money back, even if the government defaults on its debt. Liquidity. TIPS can be sold on the secondary market, which means that you can access your money if you need it. I bonds cannot be sold on the secondary market, but they can be redeemed after 5 years. Real estate has long been considered a reliable inflation hedge and a means of preserving wealth. Investments in real estate typically appreciate over time in line with inflationary pressures, providing investors with protection against rising prices. There are various options for investing in real estate, including real estate investment trusts, REITs, and direct ownership of rental properties. Each option comes with its own considerations and risks that need to be carefully evaluated. By including real estate in your investment portfolio, you can potentially offset the impacts of inflation and achieve long-term wealth preservation. Investing in commodities can be a valuable strategy for protecting your portfolio against inflation. Commodities, such as gold, are often considered inflation hedges because their value tends to rise with inflationary pressures. Gold and other precious metals have historically performed well during periods of high inflation, making them attractive investments for preserving purchasing power. Moreover, commodities like oil and energy can also serve as hedges against inflation, as their prices often rise during inflationary periods. Let's explore the benefits of investing in commodities as a means of protecting your portfolio from the effects of inflation. Here are some of the reasons why commodities are a good hedge against inflation. They are tangible assets. Commodities are physical assets, such as oil, gold, and wheat. This means that they have real value, even if the value of paper currencies declines during periods of high inflation. They are inelastic. The demand for commodities is relatively inelastic, meaning that it does not change much in response to changes in price. This means that even if the price of a commodity goes up, people will still need to buy it, which will help to keep the price from rising too high. They are globally traded. Commodities are traded on global markets, which means that their prices are not affected by the economic policies of any one country. This makes them a good hedge against inflation, even if inflation is high in one country. It is important to note that no investment is a perfect hedge against inflation. Commodities can be volatile, and their prices can go down as well as up. However, commodities can be a good way to diversify your portfolio and protect your wealth from the effects of inflation. Equity investments can be vulnerable to the impact of inflation, as rising prices erode purchasing power. However, there are strategies within the equity market that can help protect your portfolio. Dividend-paying stocks, for example, can provide a stable income stream that keeps pace with inflation. These stocks tend to be from established companies with a history of regular dividend payments. Additionally, other equity investment strategies such as value investing can provide opportunities to invest in undervalued companies that have the potential to outperform during inflationary periods. To evaluate further, equity investments are investments in companies. When inflation is high, companies that produce goods and services that are in high demand tend to do well. This is because they can raise their prices to offset the rising cost of inputs. As a result, the stock prices of these companies tend to rise. If you are considering investing in equity investments, it is important to do your research and understand the risks involved. You should also talk to a financial advisor to get personalized advice. Alternative investments, such as hedge funds and private equity, can provide diversification and potential protection against inflation. Hedge funds employ various investment strategies, including long-short equity, global macro, and event-driven, which can generate positive returns in different market environments. However, it's important to conduct thorough due diligence due to their complexity and high fees. Private equity involves investing in private companies or assets not traded on public exchanges. While these investments can be illiquid, they have the potential to deliver strong returns, especially in growing sectors. It's worth noting that private equity investments are typically reserved for institutional and accredited investors. And there you have it, intrepid learners, the intricate dance between inflation and your investments. Today, we've unveiled the curtain hiding the true impact of inflation, and armed you with the knowledge to fortify your financial fortress. Remember, safeguarding your portfolio from the erosive effects of inflation requires a strategic approach. It's like building a sturdy shield against the sands of time. Diversification across asset classes, embracing inflation-protected securities, and harnessing the power of dividend-paying stocks are all vital tools in your arsenal. But our journey doesn't end here, my friends. If you found these insights valuable, and if you felt the spark of empowerment as we delved into the world of investing, then join us on our continuous quest for financial wisdom. Don't miss out on future explorations of wealth-building strategies, market insights, and debunked myths. Hit that like button if you found today's insights eye-opening, and don't forget to subscribe to our channel. By subscribing, you'll ensure you're always in the know about the latest topics related to investing, finances, and making the most of your hard-earned money. Until next time, keep learning, keep growing, and keep those investments working for you. Happy investing!